There are three ESG red flags that show up in trade finance portfolios every single quarter, and almost nobody catches them until a regulator or an auditor does. These aren't theoretical risks. These are patterns sitting in your trade book right now, compounding quietly, and each one eventually shows up as a credit loss, a regulatory finding, or a front page reputational event. Let me show you exactly what to look for. Let's start with the one that hides behind diversification metrics. You've got a borrower. Their financials look fine. Debt service coverage is healthy. Revenue is growing. You've extended a trade facility, maybe letters of credit, maybe receivables financing. Everything checks out. But here's the question nobody in the credit committee is asking. Where does this borrower's supply chain actually run?
Hitman House thoughtful. Pull the data. If 40% or more of a borrower's supply chain runs through regions with poor environmental regulations, Southeast Asia, parts of Sub-Saharan Africa, Pacific industrial corridors in South Asia, you have a transition risk problem that doesn't show up in any credit model. And here's why it matters. Those regions are cheap today precisely because environmental enforcement is loose, but that's changing. The EU's carbon border adjustment mechanism is live. The SEC's climate disclosure rules are being phased in. The UK's Modern Slavery Act reporting requirements tighten every year. And the EU Corporate Sustainability Due Diligence Directive, the CSDDD, is going to force companies to audit their entire supply chain for environmental and human rights compliance.
When those regulations tighten, and they are tightening, this isn't speculative, those suppliers face sudden cost increases. Compliance investments they haven't made. Carbon costs they haven't priced in. And when your borrower's suppliers get more expensive overnight, your borrower's margins compress. Their cost structure changes. And suddenly, the credit risk on your trade facility is materially different from what you underwrote. This is transition risk. The Basel Committee on Banking Supervision has been clear about this. Climate-related financial risks, including transition risk in lending portfolios, need to be integrated into risk management frameworks. The European Banking Authority's 2023 ESG risk assessment found that a significant portion of EU bank exposures are linked to high carbon or environmentally sensitive sectors, and most institutions still don't have adequate tools to measure the transmission of that risk to credit quality. You didn't make a bad loan, the world changed. But the data was there. It was sitting in the supply chain geography and nobody looked. Red flag 2 is the one that people acknowledge but never act on. Your borrower's tier 1 suppliers have ESG ratings. Maybe from MSCI, maybe from Sustainalytics, maybe from ISS. And over the last 2 years, those scores have been declining. Not collapsing, just a steady downward drift, quarter after quarter. Now, a declining score on its own isn't the problem. Companies go through transitions. They acquire assets, they enter new markets. Scores fluctuate. The red flag isn't the declining score. The red flag is a declining score with no remediation plan. When a company's ESG score is dropping and their sustainability reports say things like, "We are committed to improvement," but contain no specific targets, no timeline, no capital allocation, that tells you something critical. They're not investing in sustainability. They're managing optics. And here's the analogy I use with every credit team I talk to. A declining ESG score is like a declining credit score. It doesn't mean the borrower defaults tomorrow, but it tells you the direction of travel. It tells you where things are heading if nothing changes. And if the borrower isn't doing anything to reverse the trend, if there's no plan, no investment, no remediation timeline, then you're underwriting the hope that the trajectory reverses on its own. Hope is not a risk management strategy. The Principles for Responsible Investment, the UN-backed PRI, which represents over $120 trillion in AUM, has been publishing data showing a statistically significant correlation between ESG momentum and financial performance. Companies with improving ESG trajectories tend to outperform. Companies with declining trajectories and no action plan tend to generate credit events. So when you look at your trade finance portfolio and you see a borrower whose key suppliers have declining ESG scores and no concrete remediation plan, that's not a sustainability team problem. That's a credit risk problem. Flag it, escalate it. Because if you wait for the score to collapse, you're not managing risk, you're reacting to it. Red flag 3 is the most dangerous one because you can't even see it. Your borrower has tier 1 suppliers. The direct suppliers they buy from, the companies they have contracts with, the entities that show up in their procurement data. And for the most part, those tier 1 suppliers have some level of ESG data. Maybe it's self-reported, maybe it's rated, maybe it's basic, but it exists. Now go one level deeper. Tier 2, the suppliers that supply your borrower's suppliers. And then tier 3, the raw material sources, the component manufacturers, the extraction operations. What ESG data do you have on those entities? The answer at almost every institution I've worked with is nothing. Zero. A complete blind spot. And this is precisely where the worst ESG risks hide. Forced labor, illegal mining, environmental contamination, deforestation, child labor. These violations almost never happen at the tier 1 level. Those companies are visible, audited, and reputationally exposed. The violations happen at tier 2, tier 3, and deeper, where visibility drops to zero and accountability disappears. If you can't see tier 2, you can't assess the real risk. The Financial Action Task Force flagged this explicitly in their work on trade-based money laundering and supply chain integrity. The OECD due diligence guidance for responsible supply chains requires companies to map risks beyond their direct suppliers. And the EU's CSDDD directive, which I mentioned earlier, doesn't stop at tier 1. It explicitly requires due diligence across the entire value chain, including indirect business relationships. Here's the problem for trade finance specifically. If your borrower is connected, even indirectly through tier 2 or tier 3, to a forced labor operation or an environmental violation that becomes public, the reputational and legal consequences don't stay contained at the supplier level. They flow upward. Your borrower gets named, your facility gets scrutinized, and your institution faces questions about what due diligence you performed on the supply chain you were financing. The risk isn't theoretical. In 2021, US Customs and Border Protection issued a withhold release order against a major solar panel supply chain over forced labor allegations in Xinjiang. Companies 3 and 4 tiers removed from the actual violation were disrupted. Financing was pulled. Contracts were cancelled. The entities with direct trade facilities faced immediate credit stress, not because of anything they did, but because of what was happening at tier 3. If your ESG due diligence stops at tier 1, you're looking at half the picture and calling it complete. So here's what I want you to do this week. Pull your top 10 trade finance facilities, your largest exposures, and check these 3 patterns. 1. What percentage of each borrower's supply chain runs through regions with weak environmental regulation? If it's above 40%, you have concentration risk. 2. Are any key suppliers showing declining ESG scores with no documented remediation plan? If yes, flag it for the next credit review. 3. How deep does your ESG data go? If it stops at tier 1, you have a blind spot that regulators are increasingly going to ask about. I guarantee at least one of these 3 applies to your portfolio right now. I'm building FluxForce because these red flags sit in portfolios for quarters before anyone catches them. We started with fraud detection. Aiden Flux is production ready. ESG risk monitoring across supplier tiers is on the product roadmap. If you pulled your top 10 facilities and found what I described, I want to hear about it. Specifically, which red flag showed up first and how deep did you have to dig to find it? That's exactly the kind of signal I'm designing the detection for. Link in the description, and send this to whoever runs trade finance risk. These patterns compound every quarter they go unchecked. I'll see you in the next one.